Gold has dropped more than $1,000 an ounce from its high. Not a percentage, $1,000. In a few weeks. That number alone should stop you. But here's what's stranger. It happened while the world was getting more dangerous. There's an active conflict in the Middle East. Oil is spiking. Inflation is creeping back into the conversation. These are exactly the conditions that are supposed to make gold go up. So why did it fall? That question is what this video is actually about. Because the answer tells you something most people who own gold or are thinking about buying it haven't fully understood yet. Most people carry a simple mental model for gold. The world gets scary, gold goes up. It's a safe haven, a hedge. When everything else is burning, gold holds. That model isn't wrong, it's just incomplete. And in the last few weeks, the incomplete part is what cost people money. Here's the mechanism that actually drives gold prices. Gold doesn't simply rise when risk rises. Gold rises when real yields fall, meaning when you subtract inflation from bond yields and the number gets smaller, and when the dollar weakens. Those are the two conditions that make gold worth holding instead of, say, a 10-year treasury. Now look at what actually happened. The Middle East conflict pushed oil higher. Higher oil means higher inflation expectations. Higher inflation expectations meant bond markets started pricing in fewer rate cuts from the Fed. The Fed confirmed it. Rates held at 3.5 to 3.75%, and Chair Powell said expect maybe one cut in all of 2026. So real yields stayed elevated. The opportunity cost of holding gold stayed elevated. And gold sold off. The conflict created inflation risk. The inflation risk killed the rate cut story. And without rate cuts, gold's tailwind disappeared, right at the moment the world looked most dangerous. I want to stop here and ask you directly. Did you know this before today? Did you understand that gold's relationship with crisis runs through real rates and dollar dynamics, not through fear alone? Drop your answer in the comments. I'm genuinely curious how many people watching this had a clean picture of that mechanism, because most retail investors don't, and that's not a criticism. It just means the narrative they've been sold is missing a gear. As of today, the tape looks like this. The dollar index is sitting around 99.2 and falling. That's a tailwind for metals, because a weaker dollar makes gold and silver cheaper for everyone buying in euros or yen. The 10-year yield is around 4.34% and easing. Real rates are still near 2%, which is still a headwind, but the direction is improving. CPI is steady at 2.4%, but oil is keeping inflation risk alive in the background. No major data this week, no CPI print, no jobs number. So the market is trading on sentiment, not fresh information. The geopolitical situation has stabilized slightly. Talk of delayed military action brought some relief. That helped prices today, but it's fragile. The net read? The factors that drove the sell-off are fading, but they haven't reversed cleanly. Gold is sitting at support levels, not above them. Technical analysis suggests the market is oversold on short-term charts, but oversold doesn't mean done falling. There's buying interest on dips, visible in the volume profile, but not yet the kind of sustained momentum that confirms the correction is finished. Silver is different. Silver is outperforming gold today. It's absorbing selling pressure better. It's showing relative strength. And that difference is not random. It's coming from something structural that has been building for years. Registered silver inventories on the COMEX are at roughly 80 million ounces. Registered means ounces actually available for delivery against futures contracts, not hypothetical stockpiles, not warehouse buffers. The physical metal you could demand today. That number has been falling for a long time, and it's now low enough that it's becoming a market story in its own right. The silver market has been in a supply deficit for 6 consecutive years. Production is not keeping up with demand. That's not a quarterly miss, that's a structural condition. And the demand side of the equation is only getting more complicated. Here's something most people get wrong about silver. They treat it like gold, a monetary metal, something you buy when you're nervous about the dollar or the banking system. That framing isn't wrong, but it's about half the picture. More than half of annual silver demand is industrial. Solar panels, electric vehicles, electronics, AI data center infrastructure, the wiring, the circuitry, the heat management. These sectors are not contracting, they're growing, even as some solar manufacturers experiment with reducing silver content per panel or substituting copper in certain applications as prices climbed. And yes, that's real, and it's worth knowing. The deficit has persisted anyway. The efficiency gains in manufacturing haven't kept up with the volume of demand. Quick question. Did you know silver was primarily an industrial metal? Most people who think of silver as an investment assume it behaves like a small, volatile version of gold. If that's how you've been thinking about it, that framing is going to give you the wrong read on why prices move and where the floor is. The silver squeeze is not a trader narrative that someone invented to move the market. It's a physical reality. And it's been building long enough that it's now one of the strongest fundamental signals in the entire precious metals complex. Zoom out a year, 2 years. The forces that matter at that horizon are not VWAP levels or today's dollar move. Central banks bought less gold in January than usual. That number gets headlines when it disappoints. But the 2026 forecast still calls for around 800 tons of central bank buying globally. China is the most consistent actor here. The motive isn't speculative, it's structural. Countries that want to reduce exposure to dollar-denominated assets buy gold. That process doesn't reverse on a soft monthly report. It's a multi-decade de-dollarization trend, and gold is the primary alternative reserve asset. Something else worth noting. Large, long-dated call options on gold have appeared on the COMEX in recent sessions. Not noise. Long-dated calls are expensive. They require conviction over months, not days. When institutional capital takes that position, it's worth registering. It doesn't tell you what will happen, but it tells you where some patient, sophisticated money is leaning. Gold miners and silver miners, GDX and SIL, are moving in line with the metals today. Silver miners are performing slightly better, which mirrors what spot silver is doing. When the mining stocks confirm the metals, the price action tends to be real. When the stocks diverge, it's often a warning. Right now, they're confirming. None of this removes short-term volatility. These forces take time to fully express. A market can have strong fundamentals and still fall 30% in a correction. That's not a contradiction, it's just how markets work. The question is what you're trying to do. Trade the next week or position for the next 2 years? 2 different people are watching this, so the answer is 2 different answers. If you're trading today, silver has the cleaner short-term setup. It's holding support better, volume is coming in on dips, and the relative strength is real. But this market is still volatile enough to punish size. If you're trading it, keep positions small and stops tight. Gold setup is less clean. The correction may not be finished, and buying before prices clear recent highs is buying into uncertainty. Wait for the chart to show you it's done selling. If you're an investor with a horizon of a year or more, both metals have pulled back hard from extreme levels. Gold from above $5,400 to around $4,400. Silver has corrected proportionally. From inside the move, it feels alarming. From outside, this is the kind of retracement that patient buyers look for. The practical vehicles are straightforward. GLD for gold exposure, SLV for silver, GDX for gold miners, SIL for silver miners. Low cost, liquid, and accessible. The standard framework for a diversified portfolio puts 5 to 10% in precious metals, not as a bet, but as structural insurance against inflation and dollar erosion over time. Risk management is not optional here. Gold and silver can move 2 to 3% in a single session. Size your positions so that a bad day doesn't force a decision you weren't ready to make. One question for the comments. What percentage of your portfolio is currently in precious metals? I'm asking because the range of answers I've seen on that question is enormous. Some people have 0, some people have 30%, and there's no right answer, but the conversation is worth having. The drop from $5,400 to $4,400 feels violent right now. It probably is violent, but a year from today, there's a reasonable chance it looks like the obvious entry point that everyone wished they'd used. That's how corrections in long bull markets work. They always feel worse than they are from inside them. This video is for education only. Nothing here is financial advice. You're responsible for your own research and your own decisions. The risk belongs to you, and so should the thinking.